Are you tired of seeing your dollars do the ho-hum in your low-interest savings? Discover the secrets to making your money work harder for you through the stock market or property market. We'll compare returns, crunch numbers, and get the upstairs-downstairs view from experts who've tried it all. Hit subscribe now to find out the best way to turbocharge your finances without getting burned. In terms of returns, investors commonly compare real estate versus stock investment. According to a May Gallup study, 34% of Americans feel real estate is the greatest long-term investment plan, while just 18% believe equities or mutual funds are the best long-term investment strategy. The fact is that both strategies have pros and cons. Over a shorter time horizon, stocks, for example, provide more liquidity and larger profit margins. Buying real estate may be a better option if you want stable profits and tax benefits. Understanding the benefits and drawbacks of both techniques will help you make the best investing choice, depending on your objectives and risk tolerance. You may make money by renting or flipping residential or commercial properties. However, this strategy usually necessitates a significant initial expenditure. Real estate investment trusts, or REITs, are a real estate investment that does not need you to finance or manage properties directly. REITs enable you to own a piece of a pool of income-generating assets and benefit from it. Like mutual funds, REITs may be readily bought and sold on stock markets and benefit from their diversity and liquidity. When you buy stock, you become a stakeholder in a corporation. You may earn by selling shares when the stock price increases or retaining them while the firm pays dividends. Stocks may be purchased directly via mutual funds or exchange-traded funds. Individual stock investments imply that you win or lose money depending on the success of the company's shares. On the other hand, mutual funds and ETFs enable you to diversify your portfolio by investing in numerous equities at once. Many investors purchase real estate and equities to accumulate wealth over time. While both have the potential for large rewards, they vary in rate of return, risk, liquidity, and accessibility. Returns. Stocks have historically outperformed real estate investments in terms of returns. Stocks have returned 8% to 12% per year on average, while real estate has returned 2 to 4% per year, says Peter Earle, an economist at the American Institute for Economic Research. Other factors, such as economic situations and emotional purchase choices, might lead to inferior investments and lower returns. While real estate investors may see lower overall returns than stock investors, individuals who own rental properties anticipate a consistent revenue stream from their tenants. Many financial experts say that it's much easier to find cash flow in real estate than it is in the stock or bond market. Real estate assets tend to rise in value over time. Real estate investors may profit from homeowner tax breaks, such as mortgage interest, property taxes, and depreciation deductions in the long run. Practically speaking, it's also important to know that many real estate owners use a lot of debt to buy property, which can greatly increase their return on equity. This adds some depth to the discussion between stocks and real estate. For example, if an investor puts down 20% on a $100,000 home and appreciates by 3% in a year, they would have made 15% profit on their original investment of $20,000. Costs. Fees, commissions, account management charges, and other expenditures might lower your returns in any asset class. However, investing in stocks often requires a lower initial outlay. Some people participate in DRIPs, or dividend reinvestment programs, or buy fractional shares, which allow for very small upfront investments, Earle notes. Investing in real estate via managing rental properties, on the other hand, is no small financial achievement. As a real estate investor, you are responsible for the down payment, closing fees, mortgage, and regular maintenance expenditures. Diversification. Diversify your wealth by investing in both real estate and equities. Real estate investments are good for diversification because of their low correlation with other asset classes, such as equities and bonds. On the other hand, assume an investor invests their whole portfolio in a single stock or a limited number of stocks. The lack of exposure restricts growth and exposes them to the losses of a single firm or sector. Investing in a diverse portfolio of stocks, real estate, and other asset types may help maximize rewards while limiting risk. Accessibility. Investors of varied degrees of expertise may participate in the stock market. Publicly traded companies file financial health and corporate action statements with regulators, report earnings, and information is widely available. There are market-following cable networks and a lot of social infrastructure supporting equity investors, Earl explains. On the other hand, real estate investment has a greater entry barrier than stock trading. Real estate may be difficult. There are tax ramifications, upgrades may be necessary, and in certain circumstances, there isn't a lot of organized, easily accessible information. In addition, if changes are made to create additional money, such as a home to rent, a whole new set of trade-offs is incurred, Earl explains. Liquidity. Stock investment provides more liquidity than real estate investment, allowing you to purchase and sell equities in minutes or seconds. However, as a real estate investor, you must locate a buyer and comply with legal and administrative formalities before selling, which may take weeks or months. Real estate illiquidity makes it difficult to instantly swap assets for cash, which may be a negative for investors depending on their investment objectives. Experts claim that illiquidity is the cost of obtaining attractive long-term gains. There is unquestionably a premium to be earned on investments with limited liquidity. Logically, this makes sense, since no one would give up liquidity for a return equal to or less than liquid assets. But we should also consider other factors. While trend research may give useful insight into market behavior, economic and political changes cause circumstances to shift quickly. To assess an investing plan's success, you need to examine elements other than historical patterns. Market circumstances. The economy might have an impact on real estate or stock investment results. Stock prices are more volatile than real estate prices, and while stocks tend to perform well in the early stages of an inflationary updraft, under high inflation, real estate may perform better, Earl explains. Market characteristics, always shifting, may also provide obstacles for real estate and stock investors in many ways. Public U.S. equities, as proxied by the S&P 500, are climbing the proverbial wall of worry as they trade above historical valuation levels, despite earnings softness and the Federal Reserve's inflation flight. It also observed that consumer spending is declining, which has an impact on incomes, GDP growth, and the job market. Real estate, on the other hand, may typically be used as a hedge against inflation. For example, rising inflation may cause rent hikes, increasing cash flow for investors. Conversely, a recession may reduce demand for real estate, leading property prices and rent rates to collapse. Financial objectives and time horizon. When deciding on an investing plan, keep your financial goals in mind. Stock investing may be a more successful strategy for people seeking larger returns in a shorter period. Real estate may be great for people who desire a consistent income stream and are willing to wait for a return on their investment. Risk tolerance. Investing in stocks and real estate entails varying degrees of risk. For example, investment in the stock market is more volatile than investing in real estate. However, acquiring a rental property requires a considerable upfront investment and may incur unexpected fees. Aside from whatever investing plan provides the biggest returns in the shortest period, investors need to evaluate several other aspects. Market circumstances, individual ambitions, and risk tolerance are all factors to consider. Investors should stay true to their investing goals by incorporating both equities and real estate into their portfolios and periodically rebalancing across both size and geographic constraints. It is critical to do research before making any investing selections. A financial advisor can assist you in making well-informed choices that are consistent with your risk tolerance and financial objectives.